Hi, my name is Michael Klein. I am a tax partner from the Philadelphia office. Today, I want to talk to you about 163J. For those of you that aren't familiar with that code section, when the TCJA came out in 2017, Congress sought to limit the amount of interest expense that was able to be deducted by businesses. And the way the law, just as a summary, the way the law works is you measure a business's adjusted taxable income, and you were allowed to take a deduction of interest expense equal to 30% of that amount. Now, this law was intended to only affect large corporations. Those corporations were measured by gross revenue, and if your gross revenue over a 3-year average exceeded 25 million, then you would be subject to this limitation. By the way, the limitation has increased to 26 million last year. However, there were certain exceptions to the over $25 million rule, and one of them was if you were considered a tax shelter. And if you sift through the code, we discovered that a tax shelter is defined as any type of partnership or association in which losses are allocated to more than 35% of the limited partners. If your business was defined as a tax shelter, then you would also be subject to the interest limitation. Well, that definition pretty much brought in almost all real estate developers and real estate partnerships because of the way that real estate partnerships are set up. So the limitation had a much more wider effect on clients than we had thought. So that's just a small summary of what happened with the TCJA when this 163J limitation came out. So with the CARES Act, the Congress sought to try to soften some of that blow, and it increased the limitation from 30% to 50% limitation for the years 2019 and 20. So now businesses can take an interest deduction of up to 50% of their adjusted taxable income. And adjusted taxable income for most taxpayers will be taxable income with add backs of interest expense, and for the years up to 2021, you also get to add back depreciation and amortization. In addition to increasing the limitation from 30% to 50%, which will now allow these businesses to take more of an interest expense deduction, they also added a couple more provisions that were very advantageous to the taxpayers. First, the taxpayer can elect not to use the increased limitation. I'm not sure what the scenario would be where a taxpayer would elect not to use the increased limitation, but I am sure if we think about it long enough, we'll find one. The second one was that for 2020, taxpayers can use their 2019 adjusted taxable income for 2020. The reasoning behind that is that it's believed that in 2019, most businesses will have higher adjusted taxable income than they will in 2020 because of the COVID disaster. Because the 2019 adjusted taxable income is higher, that'll allow businesses to take a larger deduction in 2020 if they use the 19 adjusted taxable income instead of 20, which is anticipated to be lower. So that provision will come through for taxpayers as they file their 2020 return. They'll measure the 2019 ATI versus the 2020 ATI, whichever is greater, that's the one they should use. It's interesting that the increase in the ATI to 50% in 2019 only applies to corporations and S corporations, and it does not apply to partnerships. The partnerships will be allowed, however, to increase the limitation from 30 to 50% in years beginning in 2020. Partnerships will also they will also be able to elect in 2020 the ability to use the 2019 ATI, as I mentioned previously. However, the partnerships don't get totally minimized because of the 2019 because they are not allowed to use the 50% limitation in 2019. The legislature put in other provisions to give them some relief in 2000 while filing their 2019 return. So partners may elect to use 50% of any of the excess business interest expense allocated to them with their 2019 K-1s as paid or accrued by the partner in the partner's first year beginning in 2020, and it will not be subject to any limitations. So what that means is if a partner was limited or a partnership was limited in deducting their interest expense in 2019, the amount that was limited got passed through to the partners to be used in a future year when the partner has excess taxable income. However, because the IRS did put the provision in to allow them now to take 50% of that excess and take it as a deduction in 2020. So if I'm a partner in a partnership and my excess business interest expense allocated to me was $200 in 2019, I'll be able to take $100 of that and use it on my 2020 return as a deduction, and the remaining $100 will be carried forward, and the 163J limitations will be applied as usual. So partnerships will receive a break in 2020. As I stated that because much of the 163J applied to real property trades or business because of the tax shelter rule, along with the TCJA, they allowed partnerships they allowed electing real property trade or businesses to elect out of the 163J limitation. If you elected out of the limitation, you were able to deduct 100% of your interest expense. However, you gave up some ability on depreciation, which I'll discuss later. Under Section 4, so the IRS issued Revenue Procedure 2020-22 last week, and under this provision, under Section 4, they're allowing real property trades or business to make a late election for years 2018, 19, or 20. So that really means is if a partnership forgot or neglected to make the election, or looking back should have made the election, they now have some relief to go back and make the election. This may allow them to deduct all of their interest expense from 18 or 19, and also 20 as well. To do this, they would need to file an amended return if they're an individual. If they're a partnership, they would need to file an amended 1065 or an AAR, as Sean talked about earlier. Under Revenue Procedure 2020-23, which Sean talked about, for filing the amended 1065, those provisions are in there. And if you are able to file an amended 1065, you must file it by October 15th, 2021. That amended return must have the late election attached to it, and the details of the election can be found in this Revenue Procedure 20-22 under Section 4.04. So the IRS is allowing you to make a late election. Because the rules changed under the CARES Act, they're also allowing you to withdraw the 163J election of electing out of it. They're allowing you to withdraw the election. So back again in 2000, when the TCJA Act came out, many real property trades or businesses made the election to not have the 163J limitation applied to them. Because of that, they were able to deduct, again, all of their interest expense. However, as I said, they did give up something. If you did elect out of 163J, you got to deduct all of your interest expense. However, you were forced to depreciate all property over a 10-year life under the ADS depreciation method. So if you were non-residential, if you had non-residential property, you would depreciate the property over 40 years as opposed to 39. And if you were residential, you were forced to depreciate over 40 years as opposed to 27 and a half if the property was placed in service before 2018. In addition, you were not allowed to take bonus depreciation on any property with a life of more than 10 years. Therefore, it didn't make much of a difference because the bonus depreciation was not allowable, as Paul Daly spoke about, until recently. So now, because of the increased limitation from 30 to 50%, and because bonus depreciation is now allowed to be taken on qualified improvement property, taxpayers may want to consider whether they want to keep this election. When the election was made, it was irrevocable, but because of this revenue procedure 20-22, it is now revocable for this year. In order to revoke the election, first of all, if you don't revoke the election, you still could get some relief because of the change in the qualified improvement property depreciation life going from 39 and a half to 15. Under the ADS life, which you're required to be on, you can depreciate this 39 and a half of your property that you were depreciating over 40 years, you can now move that to 20 years. So even if you don't withdraw the election, you still may be able to get a depreciation, an extra depreciation deduction in the current year. In order to make the election to withdraw, you must make a timely filed amended return, 1065 or AAR for the year the election was made, with the withdrawal election attached. You would see revenue in this revenue procedure 20-22. If you look at section 5.03 of the revenue procedure, it will describe the withdrawal election. So in conclusion, there's a lot to consider if 163J does apply to you, or if you elected out of 163J back when you filed your 2018 return, because of the CARES Act, the situation has changed drastically, and there are people who may want to jump into 163J and use the limitation, but there may be a great amount of people who want to revoke what was thought to be an irrevocable election.